Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Steve Rolls, Senior Portfolio Manager at Trivest Wealth Counsel. Wellington Altus Private Counsel will be joining us for the hour. In 30 minutes, we'll be joined by Randy Ollenberger, Managing Director, Oil and Gas Equity Research at BMO Capital Markets, to help break down the latest earnings from Suncor. And we want to hear from you this morning on First Call. Reach out with your questions on North American large caps, and we'll have Steve answer as many of them as he can. That's, of course, at the end of the show. Number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. There are multiple reports that there may be a potential agreement between the U.S. and Iran to end the conflict. The reports say that both sides are working toward a short, one-page memorandum, with negotiations appearing to gain momentum after a pause in U.S. military activity in the region. Officials expect a response from Iran on key issues within the next couple of days. Loblaw's first quarter results came in slightly ahead of expectations, supported by steady performance across its grocery and pharmacy businesses. The retailer saw modest growth in both food and drugstore sales, helping lift overall revenue. The company is maintaining its outlook for the year and continues to expect solid earnings growth as it invests in store improvements and operations. Shares of Disney are up in the pre-market. Profit in the latest quarter beat expectations, with strength across its entertainment, sports, and theme park businesses. Revenue also came in ahead of forecasts. The company's Parks and Experiences segment remained a major driver of profitability, alongside solid contributions from its media and sports divisions. And now our top line story. Markets are poised to open higher this morning, led by tech and easing geopolitical tensions on the hopes of a U.S.-Iran deal. Now, at the same time, continued strength in AI-driven earnings is helping power the rally. So the question now is, how sustainable is it? Let's bring in our guest for the hour, Steve Rolls, Senior Portfolio Manager at Trivest Wealth Counsel, Wellington Altus Private Counsel. Steve, thanks as always for joining us. I know it's early in Calgary, but we appreciate you getting up and popping on here. The markets seem happy. I was looking at some of the European markets. They're up over 2%. Some of them closing in on 3% on this news.
Yeah, it's a very positive development, and markets are reflecting that. We're seeing oil down, WTI down about 9% already. So and more importantly, we're seeing the bond market react. I think the 2-year in the U.S. is down about 8 basis points. So it's more momentum for the market. I still have some concerns about whether or not this is going to be a deal. Yes, it looks good, but the devil's in the detail, and we'll have to see exactly what the one-page peace plan will be, and whether or not the true decision makers, who we still don't know really are, will comply with whatever the U.S. demands are, especially on the uranium enrichment.
It is kind of fascinating that a one-page memorandum may be what settles this. I mean, what can be on a one-page deal that settles this?
Yeah, I'm a little pessimistic about the outcome. Looking back at the Iran situation, reminds me of the negotiations under the Bush administration, 2003, when they're calling it the grand bargain, with a similar type of approach of looking at uranium enrichment deal with the reformer government in 2003, which did not play out as expected. And apparently the deal on the table is that the U.S. is asking for a moratorium on uranium for 20 years. Iran apparently is saying 5 years, but this is all speculation at this movement. But let's go with the positive. Let's hope for a peace plan. I think effectively, though, I think that what will happen is that the Straits of Hormuz will be open. I look at this as similar to July 2022, when Ukraine and Russia, brokered by Turkey, came up with a deal for the grain exports. So let's get the oil moving back again. So I think it is quite positive.
And so will this turn the focus back to earnings, do you think? I mean, there has been a lot of focus, but will it really drive it back to that? The earnings season has been pretty solid.
It's quite funny. Well, not funny, but I think that the earnings momentum has been so strong that it's been pushing the geopolitical stuff to the side over the past 2 weeks here, especially last week with the great reports out of Google and Amazon and various hyperscalers. The theme right now is the earnings and the cash flow that is really being produced right now. It's an incredible, robust, groundbreaking quarter so far. 50% plus earnings in the tech side of things right now. So that's why we're seeing this great momentum so far this month.
And with it though, any concerns? I mean, this is we've talked about this a few times, but this being the year of show me or let's get it working. AI. Are we seeing that, and is that what's helping fuel this? Because there's still a huge capex going on.
Yeah, we're definitely seeing the AI demand has been super strong, and that's been the key. But the monetization is somewhat indirect. However, having said that, we are starting to see some true numbers come through, specifically with Google and with Amazon. Amazon, for instance, or not Amazon, Microsoft. Microsoft and Google are the clear winners with the monetization. Microsoft is really incorporating this into their Microsoft 365 and Azure platforms, and Google is doing the same thing, and they're really showing that their ad growth is growing as well. So it's really the two-speed economy right now with the AI demand. We have the infrastructure play with the NVIDIAs and AMD earnings last night, but we're also seeing these platform monetizations leading with Microsoft on Google's. So it is starting to show what's happening. The most relevant stat for Microsoft is that they are seeing visible revenue already for AI to be about $37 billion for their AI. So Copilot, I'm using it daily. I live off it. I'm paying for it. And it is something that's only 20 other million people are using out of the 350 million users of Microsoft 365. So there's big room for growth here, big room for revenue here. So look for Microsoft to continue to expand in this market.
Any concerns that there's too much focus on that and too much money in one spot? I mean, they're dominating the markets again. Any concern about that, or that we might see a payback at some point for it?
It's, I'm in my 50s, and of course I grew up in the business during the .com, but this is different because we are seeing formidable revenue come out of here. So to me, that's not as, when it's tangible, it works. When you see cash flow, it works. And so I'm not as concerned. Yes, they are spending a tremendous amount of money, but their cash flow is so extreme. Their metrics for their debt, yes, instead of piling up the cash and buying other companies, they're investing in themselves. But the way I look at the AI hyperscalers, they're now in the utility business. That these data centers are effectively a utility. They're very expensive, so it is a new business model. But who's going to lead it? I'd rather have these biggest companies in the world with trillion-dollar market caps be investing in that than a government. So I'm not as concerned as some are in the market.
Okay, we'll leave it on that note there, Steve, but lots more to talk about. Coming up next, we'll take a look at the markets before the bell. See how things are shaping up on the markets, and we'll start with the U.S. futures. And no surprise, they're all in the green right now. On the news out of the Middle East, that there may be a deal coming for a truce, a permanent truce between the U.S. and Iran, a one-page deal that's being looked at. We won't know for a couple of days Iran's response, but right now, Nasdaq's responding up on 1.33, S&P 500 by 0.79. Asian markets, all of them up as well on this news. Nikkei by 0.38, Hang Seng 1.22, the CSI 300 by nearly 1.5. But take a look at Europe, and I think they're happy about that news out of Iran. There was concerns, of course, there that Europe, they might be running out of oil, jet fuel, one of the big possibilities. They were talking about last shipment had just arrived, so you can see the European markets reacting very favorably to the news. FTSE 100 up by 2.5, Look at the CAC Caron by 3.36, and the DAX up by 2.6. TSX yesterday. I don't know if you to have an off day yesterday. It was down by 0.2%, but that was dragged down mostly by one stock, and that was Shopify. And let's see who were some of the winners and losers. We're going to talk about Shopify for a second, but ATS was up 6.7%. And Curaleaf got a price target raised to 650 from 5.5 at Alliance Global. Going the other way, Keyera taking a hit, off by 7.29% after regulators announced plans to challenge its planned acquisition of Plains All American Pipeline LP's Canadian natural gas liquids business. And the other one, of course, Shopify. That's what pretty much dragged everything down. It was off by 15.63%. Over concerns that the guide shows slowing revenue growth. And taking a look at the metals right now, you can see them surging on the news out of Iran. Gold up 2.5, silver as well, and that's pretty much what we're gonna see for today. Look at that, silver's up, copper as well. Look at copper, well above $6, and then oil, of course, no surprise, is going the other way. And let's take a look at Western Canadian Select from yesterday. There we go. And that was off by 3.5. You'll see that drop even more today because this is what's happening with WTI right now. Take a look at this. Let's bounce back a little bit. It actually was below 90 earlier. It's still off by 7.7% on the news out of the Middle East. We'll get about $94 a barrel. And of course, oil prices have been higher since the beginning of the U.S.-Iran war, and it's pushing inflation higher in Canada, but it's also boosting growth. So many wonder, is it a headwind or a tailwind? Our guest says it's both. Steve, you sound like a politician. Steve Rolls of Trivest Wealth Counsel, Wellington Altus Private Counsel. Walking the line there. No, just years ago, there was a politician, somebody asked, well, are you for this idea? And he said, some people are for it, some are against it. I'm for the people. And it's always stuck with me as a perfect political statement. Okay, what are the pros to what we're seeing unfold?
Well, the pros are really that as a net exporter of oil, that we benefit from these higher prices. And despite the prices coming down 7-8% today, I think with this peace plan, if it does go through, there's still going to be an undercurrent of, okay, there's still some geopolitical concerns here that this could be revamped again. So but we're not going back to pre-February 28th prices here. So I think there will be continued momentum for WTI here. But revenue side is really this: when we have higher revenues in the market, we're going to have higher revenues for the government. So that boosts capital, that boosts investments, that boosts employment. So it's the net effect is that it's good for certain regions of the country, specifically Alberta and Saskatchewan.
It's also, good for Ottawa as in the government, right? They're liking this, but it is finding a balance, though, because on the backside of this is people have to pay more for gas.
People are paying more for gas. Gas has gone up. I think March went up over 21%. For the CPI was heading in the right direction for the Bank of Canada to lower rates, but it jumped up to 2.4% from 1.8% from February to March. So when you have higher inflation, that means, well, we're going to see higher interest rates. And if you're looking at before the Iraq or Iran war on February 28th, the 2-year and pretty much all rates across all G7 countries have gone up 50 basis points here. So inflation is a concern when you have higher oil. So it's really a dilemma for Bank of Canada. Should they raise? Should they not? I think that until we have hard data, I think that they got to maintain and hold here.
And that seems to be the consensus, but they have talked about possible increases. Towards the end of the year.
Yeah, towards the end of the year, but that's really depending on it's inflation dependent. So at 2.4%, that's above targets, and it's concerned because. But at the same time, we're going to have this revenue and cash flow coming from the energy side. So I'm looking at my portfolios. I'm really looking at to combine it with both. My first topic talking about the AI demand and the monetization. So I'm really pairing up some of my portfolio with some of the AI stocks, but as well some of these energy stocks, which are more cash flow, a little bit more stability. So it's a combination to make sure that creating resilient portfolios for private wealth clients. But overall, I do feel that higher energy prices are a net benefit for Canada, as long as we don't have to increase interest rates dramatically.
Do you think we could see the government maybe offering breaks on taxes on the gas itself at the pump because it's being offset by what they're pulling in from the sale of the oil south?
We've done it before.
I mean, we already saw one already, but could we see more, do you think?
Yeah. No, it's on the table, but it's very difficult to say because it is a benefit to them too. But we saw the other day, we don't know what the oil price is on a daily basis here. But okay, oil's down today. Does that mean that it's going to come down at the pump? No. So I don't think it's should be taken for granted that we will have a tax break here.
And is there a concern? I mean, we've talked about this, maybe the impetus for more investment in Canadian oil, but if this ends up being settled in the next little while, is it easy to fall back into the old habits of just going to the Middle East for simple? The oil's easy to get there.
It's easy to get there. It's easy, and it's easy to move when things are free. But I think it just even prior to the Iran war, there was always this energy security is such a big topic. Now it's a big reality, and we went through this with COVID about supply chain demand, and we're seeing it here. So it does open up the door for investments. The issue is that from a political standpoint, I don't think Canada's ready for that just now. I think that what we'll see is continued expansion of pipelines, but not new pipelines. It takes capital, a lot of capital, to get that private money to come in. I don't know where it's going to come from. It's sort of a situation from 1957 and the Trans-Canada Pipe debate. Who's going to come in and fund this? It's the government's working hard to try to create a situation where we are investable, but we saw it back in 2017 when TMX was canceled. And that was canceled really not because of federal level, but at the provincial level. So our internal politics in Canada makes it very difficult for the legal system to work here to clear for investment here. So I don't see a big demand for expansion in the pipeline business here.
All right, we got to take a break on that note there, Steve, but we'll be back to see why Schneider Electric is on Steve's radar. Time to see what's on the radar for Steve Rolls of Trivest Wealth Counsel, Wellington Altus Private Counsel. And Steve, you've got Schneider Electric, a big European company on your radar.
Big European company. And the reason I like them is because it's a situation where you can take advantage of the AI cap spend with the data center expansion, but do it through the stability of an industrial company. The company's been around a very long time, and what they're really involved in is a lot of the energy efficiency type of business. They're involved in the transformers and circuit breakers. So if you walk around your house, you're going to probably see some Schneider Electric somewhere, but more importantly, they're being used for the data centers. So I think it's a great way to get involved in the momentum of the AI data center expansion here.
Yeah, they had record quarterly revenue. I'm just looking at some of their numbers, and it's all the data centers, isn't it?
Yes. Yeah, it's all the data centers, but there's backstop by having their regular business. So I think it's a 1-2 punch of relative to investing in a new company that nobody's heard of. 2 years ago, we didn't know about Palantir. We didn't know about Anthropic, which will come due for an IPO later this year. But it's an old school type of dividend type of paying company that is showing profits by diversifying into a new growth space. So I think it's a wonderful way to ensure you're getting some of the upside with some of the downside protection of being a good, stable business.
All right, and let's get on to Applied Materials, and they're in the software, they're the semiconductor business, right? They make wafer fabrication equipment.
Yes,
They don't even make the wafers; they make the equipment.
They do. What they really focus on is what's called etching. So as they have a semiconductor chip, they make the actual grooves inside the semiconductor chip, and so it's a real specialty. Their number one client is Taiwan Semiconductor, but they're really a leader in the space. So it's a way to look at more of a pick and a shovel type of investing for the AI. So buy what the hyperscalers are buying is kind of a common theme that I have right now, that instead of going out and making the big risk, well, let's buy a company that is involved in pretty much every single chip that's being made out there. Let's use that technology and let's get the growth out of that. So it's a strong cash flow. When AI wins, Applied is going to win as well.
And they've been around a while?
They've been, a number of years now. So it's established, formidable, good traditional tech infrastructure company.
Any potential competitors or any competitors around, or does it have a moat essentially?
There's one competitor, but I'd essentially call it, because of its specialty, it's more of a moat and its relationship with Taiwan Semiconductor. So without it, it would be trouble. So with, for instance, the boom in the memory space right now, well, they're fully part of that. So they're continuing to benefit from that. I think the earnings are next week, so we should see some strong results there.
Okay, and last one we want to talk about is Enbridge.
Yeah, this sort of complements my approach to portfolio management right now, is to balance it between AI in a safe way, but as well buy companies that have proven cash flow. When you think of Enbridge, really think of it as regulated revenue. High dividend, high cash flow, stability with the WTI price increasing. Well, there's going to be more demand for. So expect to see more flow. It's I think 60% of their revenues from the States. So continued expansion in the States. So it's regulated revenue with some growth options and as well as strong cash flow.
And they just came out, announced their quarterly dividend on June 1st for 97 cents per common share.
Yeah, they increased it a little bit. Now, the dividends come down a little bit. It was up 7%, but because the stock price has increased, I think it's down to about 5.5%, but still very attractive. If you can get 5% and get some growth, well, it's what we're looking for, beat inflation, but as well grow your portfolio. So I think it's a great complement, sort of a barbell approach with some of the AI stocks to make sure you're diversifying out. Today, oil's down, AI's up. So that's the way that the market needs to be looked at in 2026.
All right, we've got to wrap it up there, but lots more still ahead in the back half of the show. Still ahead, Suncor posting higher profit and record production in the first quarter. Earnings, though, fell short of expectations. Not by much, though. We'll break it down further. And, of course, our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email. First call, bellmedia.ca. There are multiple reports that the U.S. and Iran may be nearing a potential agreement to end the conflict. Both sides are working toward a short, one-page memorandum, with negotiations appearing to gain momentum after a pause in U.S. military activity in the region. Officials expect a response from Iran on key issues in the next couple of days, though neither the White House nor the State Department have publicly confirmed the details. Loblaw's first quarter results came in slightly ahead of expectations, supported by steady performance across its grocery and pharmacy businesses. The retailer saw modest growth in both food and drugstore sales, helping lift overall revenue. The company is maintaining its outlook for the year and continues to expect solid earnings growth as it invests in store improvements and operations. Cenovus Energy is bumping up its dividend by 10% after delivering a quarter driven by higher production and elevated oil prices. The company's strongest ever quarterly production cycle saw A significant jump in profit helped in part by stronger margins in its oil sands operations and contributions from its recent acquisition of MEG Energy. Suncor reported record-breaking first-quarter production and refining, driven by higher output across its oil sands operations. But despite those volumes, earnings still came in just shy of expectations as rising costs and slightly higher debt weighed on results. For more on this, let's bring in Randy Ollenberger, Managing Director of Oil and Gas Equity Research at BMO Capital Markets. Randy, thanks as always for joining us.
My pleasure.
Overall, how does this look to you, this report?
It's not a beat by Suncor. They've delivered 10 quarters in a row of beats. This one a little bit more modest, as you said. They did have some production outages at the Syncrude plant in the first quarter, and that really did weigh on results. Now, that was anticipated by the street, but even factoring that in, they were still able to beat estimates by about 10 cents. Also important to note that estimates actually went up by about 35% in the month of April. So, relative to where the quarter ended, expectations increased, and they still beat those increased expectations.
Steve, you want to jump in?
Yeah, thanks much. Just a quick question, just regarding the record-breaking production and refinery numbers, phenomenal. How sustainable is that into the future with discussions about increasing production? But what's your look forward going forward?
So, Suncor has done a fabulous job with their downstream assets. They've increased the capacity of the underlying assets by about 10%. And so what we're seeing is much stronger downstream performance out of the company on a sustained basis. They're on track this year to deliver downstream results of probably close to $8 billion. That would eclipse the $6 billion in change that we saw in 2022. So the downstream here should be really strong for the company as a consequence, both of the improvements they've made in the downstream, but also the macro backdrop. And we're expecting product margins to remain strong right through the second quarter as a result of the Iran war. Even if things were, settled down today, we would still see lingering impacts that would result in elevated margins right through the balance of the second quarter. So a great year for Suncor in the downstream.
And then from the refining side, that cut, what happens there?
So, again, on the downstream side of things, they'll do well. On the upstream side of things, their cost structure is very low. So Suncor has done a very good job at reducing their break-even price by $10 a barrel. It takes now about a $42 WTI price in order for them to cover off their sustaining capital and dividend. That's among the lowest in North America. So they're really well positioned relative to the rest of the sector, but obviously also relative to any drop in oil prices here. We're not clearly anticipating oil prices to drop down to those sorts of levels.
And so 42 a barrel, what have they done to get to that?
So a lot of cost reductions, but staff reductions, operating improvements, those types of things. But the biggest factor really has been improved reliability of their assets. So getting more volumes through what is essentially a fixed cost business, that has really been the big turn for the company. And it's just that reliability, and driving down those unit operating costs has really been the big factor resulting in that drop in that break-even price.
And is there more room there, or is that pretty much bottom of the barrel, so to speak?
No, they're targeting another $5 reduction in that break-even price over the next couple of years here. They just held their investor day at the end of March, and they laid out their plan to deliver another $5. That would put them basically as the lowest within North America in terms of break-even price. So, the company has made great strides, and they're expected to continue to make some solid progress over the next 2 years.
Steve?
Quick comment on the buybacks. Pretty impressive buybacks increased, and for me, that's one of the biggest positives. But as well, with the potential for growth here, do you foresee a shift of buybacks to perhaps more CapEx?
No, not really. So Suncor is targeting to maintain a capital spending program of around $6 billion a year, and they believe they can accommodate about 100,000 barrels a day of production growth, as well as offset the anticipated decline in their base mine in the 2030s. So we're not anticipating any increase in capital spending from the company. We're expecting them to maintain that $6 billion capital program. keeping in mind what that means is about $3.5 billion goes into sustaining capital, so keeping the business running and maintaining production flat. And then, the additional capital over and above that, $2.5 billion is really what goes into that growth bucket.
And what's the focus next then? What are they looking forward? What are they hoping to accomplish over the next quarter and the end of 2026?
Yeah, so the company is really continuing to lean into buybacks, as you said. But the big change here was really this 100,000 barrel a day growth project. So really what the company's done is laid out all of the opportunities they have on their in situ oil sands asset base that they believe can more than offset the decline in the base mine. So we're talking about offsetting 200 to 300,000 barrels a day production out of the base mine, and then growing another 100,000 barrels a day on top of that. So that's where the company's focus is shifting to, and that will be their focus over the next, probably 8 to 10 years as they bring that production on.
All right, Randy, we got to wrap it up there, but thanks as always for joining us. Randy Allenberg is Managing Director, Oil and Gas Equity Research at BMO Capital Markets. Still ahead, today's market drivers with Bloomberg's Steve Balgi. And of course, our phone lines are open. Steve Earle is taking your questions on North American large caps. Call us at 1-855-326-6266. You can email us, first call at bellmedia.ca. Let's take a look at some of the early market movers. We're joined now by Bloomberg's Divya Balgi, managing editor for breaking news in the Americas. And Divya, thanks as always for joining us. Let's talk AMD and the earnings from yesterday.
Yeah, I think going into its earnings, there was very, very high expectations for AMD, and they actually delivered. Their second quarter forecast that they provided came in well above expectations. The market is incredibly happy. What this is signaling is that there is still incredibly robust demand for AI, and AMD is actually showing up for it. Now, AMD is a major competitor to NVIDIA, but it just sounds like there is a lot to go around in terms of demand for chips and how much AMD can actually deliver on that front. Now, analysts are also incredibly happy with the results that have come through, and the market as well, with a very strong share price gain in pre-market trading. A lot of analysts have actually increased their share price target for AMD, some of them even doubling their share price target. Actually, I think I saw one from 265 to 525 is what one analyst had raised their share price target to. We've also seen at least one upgrade to a buy equivalent rating from one analyst. So overall, really, really strong results, really good enthusiasm from investors and analysts. I think now the focus just shifts to the second half of the year. Will they be able to continue delivering like this? Will the demand continue to stay there where they can develop more chips and actually sell them to their customers?
All right. Novo having some success with its new obesity pill?
Yeah, I think this is actually another interesting one as well. Its biggest competitor is Eli Lilly. From the perspective of the shot, the injection, Eli Lilly was actually well ahead of Novo Nordisk. Now they seem to actually perhaps have flipped the script a little bit with the oral pill that they have produced at this point. I think the number was 2 million prescriptions that they've seen so far since April 17th. Ooh. So really, really good news. This actually fueled the sales for the quarter, which is quite helpful as well. One thing to keep in mind is, this pill will probably only make up about 4% or 5% of their revenue, but still things seem to be moving in the right direction, considering if you were to look back a few months ago, it almost felt like there was no hope left for Novo Nordisk, but they seem to be coming back in this specific industry when it comes to weight loss drugs that are out there and available. I think the other thing here is, supply constraints has come up in analyst notes as to whether or not they will be able to actually keep producing and supplying. We saw this before with the injection and the shot from a lot of companies. So will they be able to supply is going to be key in order to be able to keep this momentum going in terms of revenue growth.
Okay, and quickly, last up, Disney. What's going on there?
Yeah. Big news. I mean, I was actually truly surprised by the fact that they beat expectations, strong revenues, really improved profitability, operating income from all three segments beat analyst expectations. I think one thing to keep in mind here is Bob Iger is no longer CEO, and the new CEO seems to actually have created some sort of stability for the company. Now, the question is, are we still going to see this going forward? Are people going to keep spending on parks? The streaming business was one area where they really showed up this time around. Is that momentum going to continue? I think that's what we'll have to pay attention to in the future.
All right, we'll wrap it up there, Divya, but thank you as always for joining us. Bloomberg's Divya Balji. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including Reddit. Time to take a look at some of the notable analyst calls and recommendations. Phillips Securities downgraded Reddit to accumulate from buy and lowered its price target to 200 US from 240. Social media company reporting first quarter results that fell below the firm's expectations. PayPal was raised to outperform at Daiwa. PayPal is experiencing several tailwinds driven by a strategic turnaround under new leadership and strong Q1 2026 earnings results. Well, EQ Bank says it has cleared the last regulatory step in its $800 million acquisition of PC Financial from Loblaw, with the Canadian government approving the deal. The transaction was previously cleared by Canada's competition watchdog and is set to close this summer. For more details, we sat down with EQ President and CEO Chadwick Westlake.
This is a historic pace. This is putting actions to follow all the words and the statements that have been made by the federal government of Canada needing to move faster, act with urgency, think big, really improve our competitive presence in this country. And that has happened. So we are very happy, and we applaud and are appreciative of the federal government. And earlier this afternoon at the Canadian Club, I expressed my thanks to the Prime Minister and the Minister of Finance for these actions they've taken. That it's the fastest pace in the history of Canada. You're looking at this closing by the end of summer, at which point you will have a retail front, you'll have deposits, you'll have a credit card business. All of that will be new to you. And I'm wondering where you will focus first. Well, we're going to focus on getting this deal closed very well and executed. This makes us a more complete challenger bank in this country. You're right. It completes our product shelf. It differentiates us. We're going to focus on making sure that the experience is consistent for the PC Financial customers today. We're going to strike this new long-term partnership with Loblaw and ensure consistency. We're going to bring PC Optimum to even more of our products and make sure that we maximize that loyalty program for Canadians. So we're going to focus on getting that done well while serving our existing business on the single-family lending and commercial side as well. So personal banking will be obviously important to you. I'm wondering how you will challenge the big banks in that space. Well, we have differentiated products, so no other bank can have this omni-channel setup where we're going to be where customers are, be that online with our digital platform, be it in a Loblaw store where you see our pavilions, and be it anywhere that you use PC Optimum. That's a very important loyalty program for Canadians. That's over 17 million Canadians that leverage that. We will be the exclusive financial services provider of PC Optimum. So we're going to be with where customers are with the tools and the products that they can't get anywhere else. Was that part of the bigger outlook when you were looking at PC Financial? Is that Optimum program, which so many people have bought into? Yeah, it's an important part of accelerating our strategy with the products, with cultural alignment with the companies. And I'd say Loblaw and EQB share a very shared sentiment on Canada and ensuring better lives for Canadians, better financial health for Canadians. And with PC Optimum, we can differentiate our products, but get more of those points into people's hands. That pays for groceries, gas, healthcare. It's very important these days when a lot of Canadians are struggling or want to be rewarded for their financial services. Will you change that structurally at all, or are you just looking to add points to different parts of what you have going? Yeah, we'll bring it into more of our products, more of our everyday products, maybe mortgage products. It will become part of our ecosystem, where PC Financial will eventually be rebranded simply to EQ Bank, Canada's challenger bank. PC Optimum will stay under the ownership of Loblaws, and we're going to bring the most of that to Canada. And then EQ Bank will show up all over the country. Be at the top of an Esso station, Shoppers Drug Mart. We will be everywhere where Canadians are.
Housing in this country is struggling, obviously. I'm wondering if you are making any changes to the mortgage side of your business.
Yeah, we're a reflection of everyday Canadians. And we did a poll with Angus Reid as well for our customers. What we're finding is 2 out of 3 Canadians are cutting back on non-essentials. And half of Canadians are actually having to dip into their emergency funds. That's concerning. And EQ is a reflection of everyday Canadians. So yes, we're seeing people struggle to afford new housing, to actually get a place to own or rent. And last year, we did about $6 billion in single-family mortgages and about $7 billion in CMHC insured multi-unit. So that's purpose-built, affordable. So if you want to own or rent, we're trying to get people into homes. And we underwrite to every single individual Canadian. Everyone matters, not just abroad based on your credit score. We're going to underwrite and do the work.
If there is an interest rate hike, which some are expecting now, will that challenge what you plan to do now?
No, we lend through this cycle, and we're going to help Canadians no matter what happens. I think an interest rate increase would apply more pressure on Canadians that are struggling, right? Even the increase in gas prices, that can mean some people need to trade a meal a day, right? Anything can happen. So yeah, we're very attuned to it, but we're going to lend and work through that with Canadians as rates change.
Well, I was speaking with EQ Bank President and CEO Chadwick Westlake. When we come back, Steve Rolls takes your questions on First Call. All right, time for First Call and first email, but we've got the caller first, and that's Bill from Bowmanville. Bill.
Thank you very much for taking my call. I'd like your guest thoughts on Shopify. Does he own it? Would he buy it? And what does he see for the future? Thank you.
All right, Steve.
Great. Thank you so much. Shopify, yeah, big day yesterday, being down, 15% after their earnings, which actually were quite positive. Their revenue was up 35%, but really was a story about the guidance. And that's been kind of the flavor of the day with these earnings reports. It's not so much what did you do last quarter, it's what you're going to do in the future. The guidance came in about 20%. So the market really penalized that. But it's a stock that I do not own, but I do like it, but I do not own it. I do like what they're doing with their AI and their continual growth. It is a compounder. It's a little bit too expensive for me. It's a little too volatile for me. I think the PE is close to 60 going forward and about over 100 trailing. For me, I just prefer to get more growth on the stocks for tech going down south in the U.S. and stick to Canada, stick to more cash flow type of stable industrial businesses.
Is there a point where it would get interesting for you for Shopify or no?
Not yet. The point being, I mean, they're doing everything they can to make it a formidable place. I was anxious about a couple of years ago when it became overtook Royal Bank to be the number one market cap in Canada, but it is proving its worth. I think their AI sidekick is a strong positive, but it is still related to the consumer. And I think that with consumer concerns with the K economy, with lower income and inflation, consumers suffering a little bit, I'm still not fully convinced that that's the way to play the consumer right now.
All right, let's move on to an email from Mike. I'd like to get your guest's view on CNQ, Canadian Natural Resource. Thanks.
Yeah, CNQ is one of my core holdings. It has been for a number of years. I love the cash flow. I'm a big fan of cash flow. I've been talking about it a lot today. That's what I look for. It's about stability and getting paid while you wait, strong dividend, and continued buyback. What I really like them about CNQ is that their capital return framework. So as they lower their debt, they continue to increase their dividends and continue to increase their buybacks. So I think they're planning on repurchasing about 10%. So it's a very strong support internally, but as well, we get the momentum from the market itself. So sitting at 65, it got up to close to 70 earlier this year, but I still think that it's a strong way to get involved in a cash flow producing oil company in Canada.
Okay, let's sneak another email in here. This one's from Paul. With a takeout of ARX by Shell, would you wait to ARC, not ARX? Would you wait for the takeout or sell beforehand? Would you hold the Shell shares or sell them as well. That's the she sells seashells by the seashore. Holy cow. Your guest's opinion would be greatly appreciated.
A little bit going on there. Yeah, we're coming up. When a company is being taken out and it's through a merger or an acquisition, it becomes a corporate play, not an asset play. And I think what's it at, $31.99, and I think Shell offered another dollar than that. So I believe that it's a situation where you want to make sure you're getting the full Shell value. So try to get that full value. So I wouldn't want to sell it as a discount right now, but I would continue to hold it until the deal is closed. But if it does go above that 32 level, then I would sell it. But I would prefer. I think there's some other global energy companies such as BP which offer a little bit more upside than Shell.
All right, we got about 20 seconds. Do you see more? We're actually down. Okay, do you see more M&As happening in that industry, or no? Yes or no? We're out of time. I lied, Steve.
No problem. I'm going to say no. I think it was a one-off. I think it connected to LNG Canada. So right place, right time, and the right company. So.
Okay, we got to wrap it up there, Steve. Thanks as always for joining us. Appreciate you getting up early.
Thank you, Roger.
Steve Rolls, Senior Portfolio Manager at Trivest Wealth Counsel, Wellington Altus Private Counsel. The Open's up next. Trading gets underway in 30 minutes.